In this week's update, DeepSeek earthquake changes many things. The best US sectors under Trump and the changing role for gold. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. All right, got a lot to cover. It was a huge week, so let's unpack what happened. I'm not going to spend too much time on the DeepSeek situation because I'm sure you've read more than enough of that. But look, there are a couple of points that are worth highlighting for perspective. This really does change the geopolitical thinking. It was assumed that America held the lead comfortably in technology, which then, of course, goes into matters of national security and all sorts of other areas. Well, I think that's been pretty much upended, if only at the uncertainty level. It's created a lot of uncertainty. Where does America stand now in relation to China in terms of technical capability? And when you upend suddenly, unexpectedly, you upend everything that people thought was true about the geopolitical landscape, then that has ramifications for just about everything. So I think it's conservative to say that US technology leadership is gone. They might now be neck and neck. The Americans, this might be a good kick up the rear for them in terms of really getting on with it and becoming more efficient. But I think at best, it's probably a neck and neck race at this stage. So as I said, the implications, they're huge, and more than huge, they're evolving rapidly. If anyone tries to tell you that this is going to be the outcome in 6 months, 12 months, 2 years' time, then they're kidding themselves, because this is evolving so quickly and there are so many unknowns, and we've got the biggest unknown of all, and that's our new President Trump, that it's impossible to conclude where this may end up. It's created enormous corporate issues. It's created enormous national security issues. And for me, having sort of followed the TikTok story sort of partially without a massive amount of interest over the last year or so, it just sort of feels like TikTok on steroids to me. So it'll be fascinating to watch this play out. And then, of course, this is all intertwined with what's going to happen with tariffs that have reportedly started on Canada and Mexico this weekend, and, what happens then to China, to Europe, to Australia. So it's just one big mixing bowl of uncertainty, and it is what it is. So investors need to recognize that and not hide from the fact, not stick your head in the sand and just keep doing what you've always done because you don't know what else to do. Well, there are things that you can do, and they're fairly straightforward, basic things that you can do. The impact on financial markets will be substantial, and it's unknown. So everything now is up for grabs. I would not regard anything as a certainty anymore, and no investor can assume that the status quo is going to remain. That would be a very dangerous thing to do. Now, US earnings season, we've just had a big week. We've got an even bigger week coming up. Microsoft and Meta reported. So let's just have a quick look. So today, 36% of the S&P 500 stocks have reported, and 77% beat rate on earnings. Now, that's not as high as it ever gets. I can remember into the low 80s% beat rate, but 77 is up there. And the importance of that is that the American market has been going up and up. Questions of valuation have been swirling around for years, and 77% beat rate goes a long way to quelling those sort of anxieties about American valuations. So that's the importance of this. And the second point that I think is really important is that this isn't slowing down. Week before, the blended growth rate forecast, which was actuals plus forecasts, was for 12.3% earnings growth rate. That was the week before. Now, this week, it's been ratcheted up to 13.2. So in other words, analysts are still putting their forecasts up, and or the companies that have reported have actually reported better than what the forecast was previously. So from 12.3 to 13.2, analysts and the actual results themselves are getting better. And this is the highest blended growth rate since 2021 if it ends up being achieved by the end of reporting season. So not only have we got good results, but that means that the outlook statements, the corporate outlook statements have got to be pretty solid for these numbers to be continuing to go up. And the outlook is every bit as important as the results that were declared. Last week, 5 of the 11 sectors reported more than 10% growth. That's a pretty good number. The forward PE, it's not cheap, 22 times, but certainly the growth rates go a long way to justify. This is just not an environment, putting the sudden shock of DeepSeek aside, this is just not an environment where the market is going to suddenly fall a long way. Yes, there was a big spike down on Monday night, but, it's rebounded. Google finished the week at an all-time high. So there were some stocks that were hit hard. Some have rebounded almost totally. Some haven't really rebounded that much yet, but let's give it another week or two. But putting that aside, it's very, very difficult to see a sustained downturn in the market. Now, if we look at the Magnificent Seven, expect the growth rate from here on in to be solid. Perhaps the forecasts at the moment are suggesting 20% growth, but you've really got to be realistic and acknowledge that the growth rates are likely to slow down from FY24. I think that's a much more realistic expectation than just the Mag 7 to repeat what they did in 2023 and 2024. That's easy, that's simple. It just doesn't feel realistic to me. But they're probably still going to go up in price because that sort of growth rate can sustain that. Now, here's a heartening on the surface, but partially useless fact, and that is when the S&P 500 is positive in January, the median gain for the year is 16%. When January is negative, the median gain for the rest of the year is minus 2%. That's pretty clear cut. So we've had a positive January, so the odds certainly favour the US market being higher by the end of the year. And the numbers, while they're different, it's a similar theme in Australia as well. And I know that I spent a lot of time talking about America, but there's a perfectly good reason for that, and that is that American stocks and indices and trends and sentiment sets the sentiment and the trends for the rest of the world. So unless you're looking at America to see what's going on there, you can't just look at the Australian market, or you shouldn't look at the Australian market in isolation. Now, the DeepSeek thing, it appears to be a big overreaction. I think it's pretty much washed through very quickly. But when you step back and look at technological advancement over the decades, particularly the last 2.5 decades, there is a typical progression that occurs where groundbreaking new technologies always work through these cycles. We saw it with the internet. We're now seeing it with AI. There are cycles of improvement or disruptions. And given that technology is progressing at an accelerating rate, it would actually be really quite unusual if a DeepSeek didn't come along. So I wouldn't worry about it and wring your hands about it. It's actually pretty typical and pretty normal. There was mayhem on Monday night in the States and to a degree Tuesday here. But I think the cooler heads pretty quickly worked out that this wasn't that unexpected. But the important thing, and I'm just about done with DeepSeek, there is a much bigger revolution unfolding than what DeepSeek represents. It's just a normal part of it. They've been able to do things more efficiently, and there'll be other iterations of that as well. But the much bigger revolution will be all of the infrastructure that needs to be built and all the services that plug into that. How do you get enough power in? How do you get enough cooling in? All of those sorts of things. So don't stress about what happened last Monday. It's a pretty normal sort of progression point, and we'll get more of them. We'll get more surprises, and we'll get more knee-jerk reactions from the market. So you just got to learn to deal with it. you've got to have a process and a clarity of thought that allows you to deal with it. Now, the likely outcomes, AI spending may well rise. The initial reaction was because they were able to do it for 5 million or 6 million, which is probably a complete red herring anyway. But because they were able to do it supposedly so much cheaper, that AI spending would collapse. Well, again, a lot of the cooler heads are actually predicting that what normally happens in situations like this is that because the technology becomes cheaper and more freely available to more people, that AI spending may actually rise as things become more efficient. I'm sure that the Microsofts and the Metas and the Googles will rise to the challenge. There's no question they're not going to give up without a fight and just let China take over. That's just ridiculous. So the US giants will respond, and we're going to see a real acceleration in efficiency in AI. It's likely that software will be a real beneficiary, again, because more companies will be able to access this sort of new technology. AI will become more affordable for more companies. So they're the likely outcomes. What happens to capital expenditure? Difficult to know, but I'm pretty comfortable that they're going to shift. The ones that were really good in 2024 and 2023, they're probably not going to be the ones that are the leaders in 2025. So this is where you need to be nimble and alert and responsive to where the new opportunities are. I think Monday showed, and particularly the reactions from some of the investors who, if you look at the price action charts, clearly panicked. It really shows that it's so easy if you get drawn into the sentiment, the prevailing short-term sentiment of the market, it's so easy to lose money. I just keep banging on every week about clarity and discipline and all those sorts of things. All right, let's look at American stocks. The S&P fell 1% for the week. The NASDAQ was down by 1.35%. The Russell only fell a little bit, so that's encouraging. There are other indicators that speak to the breadth of the US market, so that's a good thing. I think, as I said before, there's little risk of AI spending reducing, but what happens with infrastructure spending? Who becomes the beneficiaries? Does it go up? Does it go down? That's all a bit of an unknown at this stage. So investing in infrastructure just requires a little bit of care. The beneficiaries will change. I'm very comfortable that will be the case. Now, tech at this point in time as a sector still has the highest earnings per share growth forecast for FY25. But we've now got uncertainty. And when faced with uncertainty, generally analysts will rein in their forward forecasts. I'd just be staggered if that doesn't happen in that process, given that we've only just had the big earnings reports landed from the Microsofts. I think we're going to see a period where valuations may get wound back a little bit. So don't expect the leaders to continue to just trend up in the fashion they have been. Now, the US dollar, which we'll look at in a minute, had a successful retest of the breakout and then has bounced. We dipped and retested last week or the week before last, and then have bounced quite nicely from there. The 10-year yield didn't do much, fractionally down, and the VIX at 16.4. And even with the situation with DeepSeek, the highest VIX that I saw, I think, was around 21, which is not that high considering. All right, let's go and look at some charts now. There's the S&P on a weekly chart. So you can see at one stage, it was actually trading higher than the week before's close. But Friday took a bit of the gloss off that and it closed down towards the end. The Russell down fractionally, but that's pretty good given what happened earlier in the week. This is the equal weight S&P, pretty much line ball there. Turning to the NASDAQ, again on a weekly chart, pretty much the same as the S&P. Was trading fractionally higher partway through the week, but did close off the highs on Friday. Semiconductors naturally took a bit of a hit. It's probably a sector that is difficult to read in the short term. So I'm just staying neutral on semiconductors at this stage. All right, this is the US sectors. Let's see where the money flow went. XLY, which is heavily dominated by Amazon and Tesla. So I find this index quite misleading. I prefer to look at a bunch of 10 or 20 or 30 consumer discretionary stocks to get a sense of what's happening there. And it's very mixed. Communication services had a dip but recovered. XLK similarly, and finance also did quite well. So not a lot of change net at the sector level in America. And this is Australia over the last month. The banks just going off the planet, which is an absolute head scratcher. But encouragingly, small caps doing quite well, and also information technology. So whilst it was a very volatile week, there wasn't really that much in terms of net change. Okay, I just want to touch now on the best sectors, or the likely best sectors under Trump. I think it's pretty much a given that crypto is going to be really good for the next 3 or 4 years. There was already significant acceptance of crypto and momentum, of course, because, we've moved up very significantly in the price of Bitcoin. So that was already established. We're now getting the end of restrictive regulations that the Democrats had put in place to slow this tsunami down. So that has got to be a positive. There's the Bitcoin price on a daily basis. We closed at 102,000. But you can see since the breakout, which occurred on the 6th of November, which was the election time, then it's been a very rapid move from 74 to 110, call it roughly. And then we've had a consolidation down to a low of around 90, 92. So really, when you step back and look at this, it's been a bit volatile, but it's really nothing more than a high-level consolidation. And from a purely chart point of view, putting aside your views of what you think Bitcoin might do, if you look at that chart in isolation, you'd have to say this is a consolidation before the next move to the upside. That looks far more likely, looking at the chart, than a breakdown below 90,000. And you've just got to look at the formation of the chart pattern there to understand that is very much the case. So very positive for crypto. AI, of course, particularly in software and in infrastructure, as happens in a lot of cycles, whether it be in technology or mining or wherever it is, often some of the gems are the companies that are providing the picks and shovels services to the runaway train, which in this case is AI. And that is certainly an area where I've been doing a lot of research in America and have uncovered some companies that would appear to have fantastic growth prospects. Very exciting period for 2025. But look, the key is not knowing which sectors to be in. This is an interesting list that I'll present to you, but that's not the key. The real value is being able to identify what are the best stocks, what are the individual stocks that are going to do well. So how do you become a better stock picker? And the answer to that is you find stocks that have got sustainable, high business growth rates with a high degree of probability. That's a very simple statement, and there's a lot then that goes into uncovering that, and that things that feed into the skill of the management. Founder-led businesses are fantastic. You want management that's got vision and enthusiasm for what they're doing. You need a long runway for growth, and that, of course, is helped by the fact that there is powerful secular tailwinds for that particular sector, and that in itself creates the long runway. You want a self-funding model as much as possible so that the company doesn't have to continually be going to the market to raise capital. Lots of free cash flow and a balance sheet in really good shape. So these are some of the things that that go into finding these companies that have got sustainable, high business growth rates. And this is something that we've had running for a while now with Insiders Club members, and it's very much about building confidence. Confidence is absolutely everything. And I just want to show you a graphic that we have. So this is up on our website. So right at the top, in the start of 2023, we defined stocks that are strong long-term investments along the lines of what I've just talked about. They've got high probability, high sustainable growth rates. So combining all of the recommendations for both Australia and America for the last 2 and a bit years, so 25 months, this is currently both closed and open positions. And as you can see, we've achieved a 61% win rate. And the average winners is close to 3 times the size of the average losers. And that all distills out to a profit factor of 4.32 up here at top right. So they're very pleasing results. If anyone wants any more details, of course, go to our website and you'll be able to look at that more thoroughly. All right, moving on now with the best sectors under Trump. I think there's no doubt financial services are going to do well. All the deregulation, the tax cuts, they're all going to feed into better conditions for financial services companies. Domestic manufacturing, probably not getting as much airplay as it deserves, but the 15% tax rate and the setting up of special economic zones, these are going to be positives for certain companies. It's not going to be across the board. It's going to be beneficiaries very much on an individual basis. But yeah, the domestic manufacturing in America, I think there's going to be some terrific opportunities there. Now, the sectors that are questionable. Now, energy, I think there's going to be the law of unintended consequences come in here, because when you dramatically change the production rate of something, which is what Trump is intending to do, then who knows what will that do to the price of oil? And then, of course, that feeds into many other areas. So that's a bit of an unknown for me. So I don't have a huge amount of confidence about the direction of the energy. And similarly with consumer discretionary, I don't have a lot of confidence in whether tariffs are going to be positive, negative, or neutral. And I don't think about it too much. I don't try to work it out because I think it's a bit unknowable at this stage. And then, of course, we've got inflation. What are the inflationary effects for America of imposing all these tariffs? So the reality under Trump is that policies may shift radically, probably will shift radically. That will mean stock volatility is going to rise. So we're going to see more of last Monday type exercises, I think. So therefore, it comes back to the key point that I hammer every week. A clear plan is essential. And just think about how you responded to last Monday. What were you feeling? Did it cause you to be uncertain, undecided, a bit panicky? Just consider how you reacted to last Monday. And I think everyone would have to acknowledge that the clearer you are about what you're doing and your approach to the market, then the better. The beneficiaries will evolve. It's just going to be an absolute stock picker's paradise for people who are nimble on their feet, who are flexible in their thinking, who don't get stuck in the stocks that they've been in for years because they feel comfortable. And above all, you've got to be decisive. Conditions change, then you've got to be willing to change with them. And for Australian-only investors, the ones that don't have anything to do with America, what US stocks do sets the tone. You cannot afford to switch off to these American trends. And this is what a clear and consistent program delivers. Okay, moving on to Australia. Frankly, I just throw my hands in the air in expiration with the ASX 200 index. Our dollar, 62.2. Our index went up nearly 1.5% for the week, which is not what I was expecting. And it's the strength in the finance area, in the big four banks, that is really dragging the index up. And from a valuation perspective, it's just cloud cuckoo land, in my view, and many other analysts' point of view as well. So the Australian market, more than any other, is just so essential to be a good stock picker. I just want to touch on the currencies because they're important. There is the ASX 200 on a weekly chart, so you can see it was a very positive week, hardly impacted at all by what happened in the US. That is not the outcome that I expected at the start of Tuesday morning. Now, the US currency, you can see we broke out. This is a weekly chart. We broke out in December. reached a high of 110 and then pulled back very sharply to retest that breakout, and then it bounced again last week. So technically, this is behaving itself pretty much as you would expect. And with the US dollar rising, of course, our dollar is now very much at risk of moving below this 61.5 level, and that won't do any good things for inflation in this country. All right, turning now to precious metals. Gold was up $27 to almost 2,800 and almost 4,500 in Australian dollars. And silver, 31.28. Now, China's central bank holds 5.5% of global reserves according to the World Gold Council. And also we've now got Chinese retail investors that are buying gold ETFs. And the number that I've recently seen is that there's been a 150% rise in the amount of money, the holdings within Chinese gold ETFs. So that is certainly a significant driver of the gold price. And part of the reason for that is that gold's role is changing, or being added to, if you like. So one of the strongest relationships when it comes to the gold price for decades has been the real interest rates. When real interest rates are negative, that's good for gold, because obviously gold investors are not worried about giving up potential yield. But there is now this additional dynamic, and it's going to accelerate very much under Trump, is that sanctions against various countries has got many other countries looking over their shoulder and wondering, if they're going to be next. And so we're seeing this increasing trend for gold to be a diversifier, to holding US dollars. So a lot of other countries that were traditional holders of US currency are now looking to diversify. And obviously gold and even cryptocurrencies are obvious diversifiers. Let's take a look at the charts. Go back to silver first of all. So there's a silver chart on a weekly basis. It's still in this sort of mushy washing machine kind of chop between 28 and 34. But it still is heading upwards. We are getting higher lows, but it's a bit volatile. This is gold. So gold is now broken out, ran to 2,800 for the week. And that is a very, very strong uptrend. And there we are in Australian dollars at 4,500. And the Australian gold stocks, particularly Australian producers, are having a pretty good time of it now, both fundamentally and technically. Looking at Bitcoin now, Bitcoin very much going mainstream. Institutional investment was already strong and ongoing in 2024. There were multiple ETFs and options plays that were bringing in new and substantial money, so that, this is not just the same old trade churning over and over. There's a lot of new money coming into this. The Trump effect of deregulation and policies are going to be a big bonus. There's much question about that. They're talking about setting up a strategic Bitcoin reserve in the US, so another source of demand, which is new. So we've got fixed supply, and we've got new and ongoing sources of demand coming into the market. You don't need to be very good at maths to work out what that does to the Bitcoin price. Greater regulatory clarity is going to be a very good thing, because it's going to make potential new players more confident that it's not just a Wild West rodeo. So that's got to be a positive thing. And then we also had Powell giving the tick of approval that US banks can now serve crypto clients as well. So there's just so many boxes being ticked here, and you get the sense that there's an acceleration. Now, I'm making no prediction at all about where the Bitcoin price goes, because it's just not my area of expertise. And I was a Bitcoin skeptic until partway through 2024. But there are just, I work on probabilities. That's what investing is about. And there are just so many boxes being ticked with Bitcoin that it improves the probabilities. Oh, and I forgot, CME is also about to launch financially settled options on Bitcoin futures. So just bit by bit, the building blocks are being put in place. And if we look at the chart, as we looked at a little earlier, 102,400 is where it finished. And it looks more like a high-level consolidation before the next move, whatever that may be, than it does a topping pattern. Other commodities, copper, down ticked just a few cents. Nickel back down under $7. Crude oil eased again, 72.5. And the call from Trump, drill baby drill, really only has one particular outcome. They're going to be increasing their production. There's going to be some restrictions, though, because America, it's not just as simple as total volume of crude oil for them to process. There are some crude oils that they produce that they cannot or do not want to process. So it's about getting that mix of crude oils right as well. But there's an old adage, don't bet against the Fed. And I think there'll be perhaps a new adage in the next 4 years. Don't bet against Trump either, because he just gets things done. And I suspect he'll get things done a lot more than he did during his first presidency. An interesting fact to mull over is that more than 50% of the world's global emitters have no net zero intention. You just think about that relative to the narrative that is going on in Australia. So where does that leave the ideologues? Don't know, but worth thinking about. Uranium. There are numerous geopolitical issues. There are tariffs, there are sanctions, there are bans. I mean, it really is a difficult landscape. But long term, we've got almost assured demand increases. You've just got to look at the data on the number of new nuclear reactors that are either in construction or are planned to understand that that's very much the case. There is a big divergence between the uranium price and the price of producers and about to be producers. And those sort of divergences almost always create an opportunity. Now, the prices of uranium have been heading down since January 2024, but long-term, the fundamentals remain strong and improving. So this is a market that is opaque, it's volatile, but the fundamentals do remain strong. So the short-term direction or the medium-term direction of the uranium price is not an indicator of how well the sector is going. Stocks peaked a little later. They peaked about 5 months later, but they've fallen far, far more. So hence the divergence opportunity. There's the spot uranium chart over the last 5 years. So there was the peak in 2024 at about $107, and we're now basically down to 70. But if you look at, let me just give you a relative comparison chart on some of these stocks. All right, this is a relative comparison chart looking at Paladin, Deep Yellow, Boss Energy, Lotus Resources, and Cameco. There's no recommendations here. It's just looking at the relative performance. So over the last 5 years, starting from the same point, you can see that Paladin and Boss were the outperformers in Australia, and they're the more advanced projects, so that makes sense. And then we've got Cameco sitting somewhere in the middle, and then a couple of development, or some of the better development stocks, DYL and Lotus down the bottom. But let's just zero in a little bit on what has happened since peaked out in May of last year. So you can see they've fallen quite significantly. In the case of Paladin, it fell by roughly half. Similar for some of the other stocks as well. Just starting to turn up of late. So hence potential divergence opportunity there in the uranium sector. All right, just about there to wrap up. So my final thoughts over the last week, it was a real bonus for those that had already done their homework, that knew the quality of the horse that they were riding, didn't overreact to what the market threw at them when a lot of people panicked. And also an opportunity to pick up stocks that suddenly became 30 or 40% cheaper with no particular rational basis. And we're going to continue to see that throughout this year. We're going to see new stocks that are going to gain favour. They're going to start to run hard. So many exciting opportunities. And it all gets down to the things that are really important. It's clarity about what you're doing and your process, the flexibility to remain open-minded. And then when you see an opportunity, pull the trigger. Be decisive. Don't beat around the bush. Just get it done. Fundamental analysis provides the long-term flow, if you like. So there's nothing wrong with doing high-quality fundamental analysis, but just understand that if you want to get your timing right, then technical analysis skills are an absolute must. Portfolio analyst this week, going to be addressing the question, how do we handle days like we saw last Monday, January 27, or August 5 of last year, or the time when COVID first hit and the world was being shut down? How do we handle days and periods like that? And I think that's a very worthwhile topic. And also going to be looking at what were deemed to be the strong buys for 2024. So a big and important session in Portfolio Analyst this week. If you haven't taken the $1 trial for 2 weeks, I think you'll find this week's session pretty fascinating. That's it for this week. A long session. Boy, so much to unpack. More information on the website. Here's my email address. And I'll be back with you next weekend. Cheers.